So there are a few, to Jonathan's point, this disconnect that we find between the by the book classroom experience versus what we actually experience as we go through life as investors. And the first one is honestly one that I maybe taken issue with for the longest. It's this central assumption of market theory that is at all times all investors are acting in a rational manner. That's to say that everybody is making optimal investment decisions to maximize their return for their preferred level of risk. And
Yeah, I have personally have trouble with that just a little bit. I mean, I would like to believe that I act rationally, making all financial decisions all of the time. I'll be the first one to admit emotion comes into even my decision making.
yeah, nobody's immune from it.
Yeah, yeah. Uh, whether again it's the type of trip you might take, or a car you might drive, or the house or anything. It's like it's what would the rational person do versus what would the emotional decision actually you end up doing.
Yeah. So the next one is this assumption that markets are always at all times efficient, which is to say that the price of all financial instruments immediately reflects all known information, and therefore their price at any given moment must be an accurate representation of their intrinsic value. Now, this is, I think, generally true, but sometimes it takes a while for that sometimes it takes a while for that to manifest itself fully.
Yeah. And that's a central tenet of kind of how we even build portfolios. It's based on efficient markets. But granted, when we're designing and building portfolios, that's based over very long time periods to be successful.
Right.
Not what might happen in the next week or month.
Right. So the next assumption is that stock prices are supposed to track the economy. If GDP goes up, therefore earnings will go up, therefore stock prices will go up. And also meaning the inverse is expected to be true. GDP goes down, earnings go down, therefore stock prices go down. It seems pretty simple, but it doesn't always play out like that. At least not in every increment of time.
Right.
And closely related to that, which I think is what a lot of us are led to believe through more popular financial press, is that if X happens, Y will follow. And there's a lot of examples of this. A current example is going to be, if the economy is weak, then stock prices will remain weak. If earnings decline, like I just said, then stock prices will decline. Or if anybody had a chance to read our pieces on inflation in the last month, if money is printed, therefore inflation will follow. And there again, some of these things may be true in a controlled experiment, and to be sure, many of them do have elements of truth in them. However, there's one key point to remember as we really try and accept the difficulty of explaining and the impossibility of controlling markets, is that markets live in the messy real world that rarely resembles a controlled experiment.